Five, four, three, two. Good day, everyone. We are the Injections, and we are going to summarize the topic for this week, which is financial markets and institutions. Raising a capital is often a concern of every businesses, individuals, as well as the government, for the reason that they have capital expenditures, and not having enough funds need to raise capital in the financial markets. On the other hand, some individuals and firms have surplus funds. They either save them for future use or invest it expecting to earn a return on investment, which can also help and benefit those people who need capital. There are three ways of transfer how efficient markets promote efficient allocation of capital, from those with surplus funds to those who need capital. First would be direct transfers. You can see here in the diagram that there is a direct transfer of money and securities from businesses to savers. This transfer mostly applies to small firms. The second would be indirect transfers through investment banks, wherein the business securities and savers money pass through the investment banks such as BDO. And lastly would be indirect transfers through a financial intermediary such as banks, insurance company, and so on. As you can see, the intermediary creates new form of capital in which much better for savers to hold. Accordingly, to facilitate an efficient allocation of capital and raise it efficiently, managers and individuals must know and understand how markets and institutions work.
So financial markets. Financial markets are any marketplace where the trading of securities occurs. Stock market, bond market, forex market, and derivatives. It is vital to the smooth operation of capitalist economies. It helps facilitate capital formation and liquidity. Liquidity in the sense that it makes it easy to buyer and sellers to trade their financial holdings. And it rely heavily on informational transparency. So we have here six types of financial markets: money market, capital market, spot market, future market, bond market, and stock market. So first is money market. Money market trade in products with highly liquid short-term maturities of less than 1 year. Promissory note, bills of exchange or commercial bills, treasury bills, repurchase agreement are some of the examples of money market. And we have here capital market. It is where the long-term debt or equity-backed securities are bought and sold. It helps channelize surplus funds from savers to institutions, which then invest them into productive use. Then spot market. It is where financial instruments such as commodities, currencies, and securities are traded for immediate delivery. It is also referred to as physical markets or cash markets. And then future market, also known as auction market, in which participants buy and sell commodity and futures contracts for delivery on a specified future date. Futures are exchange traded derivatives contracts that lock in future delivery of a commodity or security at a price set today.
To continue, let's talk about bond market and stock market. So first, bond market, or also called as debt or credit market, wherein corporations or government issue debt securities. This market does not have a centralized location and mainly transact over the counter, more prone to risk in inflation and interest rates, and end up in a credit risk. On the other hand, stock market, or the trading of shares issued by corporations. So there are types of stock market transactions for publicly owned companies. First is the outstanding shares traded in secondary market. The second is additional shares sold in primary market. And the third one is the initial public offering or IPO, which is the process of going public through a new stock issuance, wherein shares of a private company will be offered to a general public. There are advantages of engaging into IPO, one of which is to boost credibility. Also, its disadvantage is the strict requirements by SEC when it comes to transparency. And finally, the recent trend, which is the derivative markets or financial contracts, which value is dependent on the underlying assets. The value of these underlying assets keeps changing according to market conditions. The basic principle behind entering into derivative is to earn profits by speculating on value of the underlying assets in the future. So speaking of future, if the market price of the underlying asset decreases, it will be burdened by the buyer. Thus, if the market price increase at the time which the contract will be completed, it will be a loss for the seller because the buyer is only bound to pay the amount in the contract.
So now let's talk about the major types of financial institutions. So first we have the central banks. These banks are given privileged control over the production and distribution of money and credit for a nation or a group of nations. It also issues currencies and sets interest rates on loans and bonds. Central banks are responsible for the formulation of monetary policy and the regulation of member banks. So these banks are inherently non-market based or even anti-competitive institutions. So it acts as an emergency lender to distressed commercial banks and other institutions, and sometimes even a government. So next we have the retail and commercial banks. So retail banks offered products to individual consumers. It it is what most people think when they consider personal banking. So on the other hand, commercial banks work directly with businesses. So it offers its products to institutions for institutional and corporate use. So both retail and commercial banks offers checking and savings account, certificate of deposit, personal and mortgage loans, credit cards, and business banking accounts. So the third one, we have the internet banks. It is a newer entrant to the financial institution market, which works similarly to retail banks. So it is done through online platforms. So this kind of bank is suitable especially during this pandemic because it offers customers to access their account online, transfer money, or perform other tasks with just a click on their gadget. So next is the credit unions. So these are cooperative associations whose members are supposed to have a common bond. So credit unions are owned by their members and operate for their benefit. And one of the benefits of credit union is because they are not to profit enterprises, they enjoy tax exempt status.
So thank you, Tresme. So for the continuation of the major types of financial institution, the next one is Savings and Loan Association. It is sometimes called a thrift institution or simply a savings and loan. It is a financial institution that specializes in accepting savings deposits and making mortgage and other loans. It have a unique legal restrictions as to how their assets can be used. It provides no more than 20% of total lending to business. So the next one is the investment banks and companies. So investment banks is a financial institution that acts as an intermediary that raises capital and engages in advisory-based financial transactions on behalf of individuals, business, and governments, while the investment companies is a corporation or trust engaged in a business of investing pooled capital of investors in financial securities. The next one is the brokerage firm. So those are financial institutions that help you buy and sell securities, or they act as a middleman between the buyer and the seller. So the next one is the insurance company. It is a financial institution that protects individual and business against unpredictable risk of financial loss due to death, disability, accidents, property damage, and other complication. So the next one is the mortgage company. It is often just the originator of a loan. It markets itself to potential borrowers and seeks funding from one of several client financial institutions that provides the capital for the mortgages itself. So that's all for the major types of financial institution provided in the supplementary materials, but there are many other financial institutions that's stated in the book, such as pension funds, mutual funds, exchange traded funds, hedge funds, private equity company, and many more. Thank
Why are financial markets essential for a healthy economy and economic growth? So, a healthy economy is dependent on efficient fund transfers from people or net savers to firms and individuals who need capital. Further, without efficient transfers, the economy cannot function, which will obviously result to unhealthy economy, meaning lower unemployment and lower productivity. Equally important, financial institutions quality plays a significant and positive role in economic growth. That would be all for the presentation of group injections. Thank you and good morning.
Okay, thank you. So, I think one of the clear takeaways from the group so far, although we still have one group left, I think one of the clear takeaways is the importance of financial institutions or financial intermediaries. Most of the groups presented the models for the capital allocation process. A lot of what's going on in the real world really involves an intermediary. So we don't very much see the real world portrayal of the first model, which is shown in the book, which is the direct transfer thing. So we don't kayo see that. Uh, Now, My question is, since one of the topics that will be taken up in this course would be the global financial crisis, and I'm not sure, but probably in your other courses you discussed about the Enron scandal of 2002. Although that's more of an accounting fraud thing, no? And then the global financial crisis of 2008, 2009, or 2007, 2009, something like that. Do you think, my question is, do you think the involvement of intermediaries is problematic? Is it a problem nga there is that involvement of intermediaries? Because the 2008 financial crisis actually involved intermediaries.
So, good morning, ma'am. So, even though I'm not familiar with that crisis, ma'am, um, even though I will try to explain. So, I think that the involvement of financial intermediaries is not a problematic thing, ma'am, because um, as what we have presented, ma'am, financial markets and financial institutions plays a vital role in the economy, ma'am. Thus, they have um, they control, or they are one of the factors that controls the efficient funds transfers from people of and or the net savers, ma'am. And that efficient transfers, ma'am, kanang that efficient transfers helps the economy function well.
All right, thank you. And
I
then, yes, yes.
to add on, ma'am, the existence methods of the intermediaries, ma'am, greatly kind of increases the efficiency of funds and the capital markets, ma'am. That's why, ma'am, dili kay siya problematic.
Okay, thank you. So let's go to the last group.